On today's Lunch and Learn, we're going to be spending a bunch of time talking about angel investors and angel investing and how they fit into the startup ecosystem. And we're joined by Jed Ng, who is one of Asia Pacific's most prolific and experienced tech angel investors. He's been an operator too. He's been part of building the world's largest API marketplace with an A16Z backed startup. We'll ask him to talk a little bit about that experience too. And like Emily and like myself, and perhaps like some of you, he's a self-taught angel investor himself. But perhaps, unlike some of us, his portfolio already includes 2 unicorns, and his syndicate includes more than 1,400 members. So he's now teaching others what he knows about angel investing and also what he knows about establishing and growing angel syndicates with his new venture, AngelSchool.vc. So here at today's Lunch and Learn session, we're going to cover Jed's journey from self-taught angel to syndicate lead, cover some advice for angels starting out, and perhaps also what Jed looks for as an investor before backing a startup. Jed, thank you very much for joining us for today's session. How's the weather there in Singapore today? Let me guess, warm and humid?
It's some combination of hot, humid, and wet, somewhere in between. So you take your pick.
I'll go with that. Air conditioned. That's how it really is. I'm going to start with a little bit of a warm-up question. Lately, when I've been doing interviews with people, I've been asking them, when you were a kid, what did you think that you were going to do when you grew up?
So when I was very young, I wanted to be a vet because somehow it got in my head that I love animals. I mean, that's kind of intuitive. I think in my 20s, I almost went down a tangent. I got quite into rock climbing and I got fairly strong at one point, even though I started quite late in life. So I thought I might have shot as a pro climber, but that never worked out. And I don't think in hindsight, I'm actually talented enough to crack that tier.
Wow. Did you have the support of your parents in pursuing that goal, or did they have other ambitions for you in their profession?
I had none of the support for either of those ambitions.
What sort of profession did your parents hope you might go into?
Yeah, I think at the risk of sounding like a bit of a stereotype, there's a bit of this stereotypical Asian tiger parent type of career trajectory and path in life, which I've kind of come to realize that even though I did grow up in Singapore and spend the first half of my life here, jokingly say I'm casually Asian, which is that, or I'm quite a bad Asian or bad Singaporean, I'm not good at following rules. I'm bad at school. It's everything society hates, which kind of fits into my typology and some of the paths that I've chosen. They're a bit unconventional.
Cool. Tell us about that first sidestep you made out of whatever you were doing before startups and into startups. What happened?
Yeah, certainly. I'm going to get a little bit personal and vulnerable with all of you, right? I hope that's okay.
Thank
It's not apparent. It's not something that I talk about from a professional branding point of view, but in a previous life, I actually used to work in oil and gas, right? The situations that I ended up there after undergrad were a little bit circumstantial, right? Family wasn't doing well financially, and it was a boom period in the sector. And it was honestly a cash grab to stabilize things. But I found myself, in my 20s, not being challenged, being desperately bored. And it always sat very uncomfortably with me, right? Something's not right here. I can't be working like this. And I had to go through quite a big personal evolution to reinvention, I would call it, to get to where I want to be. Right. And that path took me to, going back to school. I did my MBA in Europe at INSEAD. And that was the first step in a long series of career transitions, going into the corporate world, working in tech. And then I think subconsciously migrating to earlier and earlier stages of whatever I was doing. It started out with strategy, then it was new business development, then I was setting up new business units, eventually, doing innovation and then working with startups. And that's sort of how I think I fell down the rabbit hole. It wasn't anything that was deliberately architected. like we often tell in a job interview or something of that nature, but something I sort of just approach, as a matter of like evolution and interest. And I will fully admit that I wasn't fully conscious about some of these decisions. And now I am a lot more clear headed around direction and how I want to move forward.
You seem like a pretty directed person. What directed you towards building something in the API marketplace space?
Yeah, I think fundamentally, philosophically, right, what I'm driven towards, and probably the same for a lot of us here, is like, why are we driven to venture angel investing startups? There are surely easier, less risky ways to make money, right? I think there's a certain intellectual curiosity, something that we all gravitate to individually, in terms of building new and creating innovation that drives us. The API marketplace, I love that idea in terms of how scalable the business model was, right? The concept, if this sounds weird to you, think of this as an app store for API services. The same way you've got an app store to download consumer apps, it was one where developers could find these third-party apps to build applications from. What was really interesting to me about this business model is, okay, we've got a really fragmented landscape where developers wanting to do this stuff need to just search on the internet, and it's a pain in the ass. So if you had one platform for discovery and to connect to all of these services, you become a very sticky touch. It is also the only marketplace that I can think of where the buyer and seller persona are more or less the same, right? Classically, marketplaces, two-sided businesses, the hard part is getting this flywheel going, right, between the buyer and the seller. And often you've got this subsidized supply side in order to get demand going. But with an API marketplace, you actually have a lot less of that because the publishers of APIs and the consumers are also developers. So that's kind of like one of those like light bulb epiphany moments that, hey, this could like be really big, really fast.
That's very cool. How big did it get and how fast?
In terms of scaling, usage and adoption very quickly, just because you've got all these vectors for growth, right? The more APIs you onboard to the platform, the more attractive it becomes. So there's that. With an API marketplace, we monetize on the number of users, more or less. So once a developer plugs in, as long as the app was still running, if the app was growing, we monetize accordingly. I guess the tricky part about this business is that you are monetizing on fractions of a cent at a time across millions of API calls, right? And a lot of these apps, 80% of them, maybe they don't ever go anywhere, but a few of them will go very quickly. So the scaling could go very quickly, but monetization turned out to be more challenging than we expected. But, point is here, like we were serving million scale developers, really.
You touched on some really interesting thinking there around the dynamics of marketplace startups and supply and demand and having to subsidize supply to create demand. And I'd love to come back and talk with you some more about that at another time, because marketplace startups have been a big part of the Australian tech startup industry since the early days. But today, this is about angel investing. So what was your journey from operator in startups into becoming an angel investor and a syndicate lead?
Sure. So this is a good time to talk about this because we were talking about the API marketplace, and this was when I was neck deep in venture and all things startup. I wanted to learn the investor side of the equation, had an interest in VC, but frankly couldn't get hired to save my life. Part of it is there's a lot more demand than there are open positions. I didn't have the right pedigree, the positioning, whatever it is, right? I do think as a general statement, venture as an industry is a little bit more gatekeepy than a lot of others, which is something that I do believe needs to change. We can talk about that later. But the point is, given this situation, I decided to learn angel investing with balance sheet capital, which, when you think about it, is a very unintuitive way to learn. The analogy is I'm going to go to the casino to learn to play poker and bet against the house.
With my own money. That's what you mean
With
by
my own-
balance sheet capital.
Exactly. That's
Mhm.
right. It's very unintuitive and yet exceedingly common, too common. I think there's a better way to solve this problem, but that's a separate talk. I'd say that in spite of my better judgment, Alan, it's worked out okay for me. You kind of talked about an exit that I've done, the companies in my portfolio that have gone unicorn. In fact, Turing.com just announced the Series E 2 or 3 weeks ago at $2.2 billion valuation. So we've come and doubled that up.
Congratulations. That's awesome.
Thank you. Appreciate it. But I had the beginnings of some data points. I wanted to scale the impact of what I was doing. This was around 2020. And then there's this crazy thing in the world called the pandemic. So immediately any notion of maybe starting a fund and all of this goes out the window. It would be a fool's errand. And so I went down this alternative path. I think it's also the universe giving me a sign that says, mate, that is not your path, right? You got to find some way forward. In hindsight, I'm glad I did, because as you said, we've built and grown a very large, sizable network. We're at 1,400 investors. We've written 7-figure checks. Today, our acquisition of investors is completely inbound and referral based. It works at scale. Scale is on the upper end. I'd say it's got to be top decile. If you look at angel and syndicates around the world, what's more interesting to me actually is efficiency. Because as you will know, operating this vehicle, it's quite a heavy lift, right? There's a lot of high touch relationships and how do you balance things out? So efficiency for me means I spend $60 a month on my tech stack to manage my investor community. So today I have no team, right? So the Easter egg in my background here is that I have one chair in the background because that's all we need seating here for. I'm being a bit facetious, right? But the question is, how do you get there? How did we get there, right? It wasn't accidental. I sort of approached syndicate building almost like building a bootstrap startup. We went back to first principles and literally questioned every single assumption and decision that other angel networks or syndicates were making, and not to be contrarian for its own sake, but to say, does this actually make sense? Like, why are we doing like this? Is there a better way? And things like that. But yes, it's this course of just experimentation that we figured out how to crack this puzzle.
Jed, we've got a hand up from Emily Rich.
Hey, Emily, did I triple
Hey.
wire?
I do want to know what your tech stack is, because I'm looking for efficiencies as well, as I think a lot of us are. I've recently am trying to do some things where, I can get more, almost try to make more time in my day than what I have. So yeah, really interested to hear what it is you do.
Yeah. Emily, let me reach out later and send you some resources.
Like-
But to simplify it, and the tech stack it's less technology than you would expect. We need a CRM. You need a record for all of your investors. You need to be able to store metadata, like who's looking at which deals and then how much they invested. To distribute deal flow and to nurture interest, we just use email automation. We don't have platform like how people ask, you think of like Aussie Angels or something of that nature. I find it's a double-edged sword. Like email is great because there's analytics tracking. You can also reach people where they're doing their work, right? Not say, hey, go somewhere else. There is some nuance around workflow process and how you execute these steps. But like I said, let me follow up with you.
Perfect.
Thanks.
Cool. Thanks, Emily. Jed, that is nevertheless very efficient. $60 a month to be able to write a 7-figure check and presumably, charge a carry on those investments if successful in future.
Yeah, to be clear, I'm just thinking about how I could potentially get rid of Alan. $60 a month sounds pretty good.
You didn't need me for the lunch and learn, Darren.
We're getting a lot contentious now. It's third episode.
It's a dog eat dog world out there.
I designed the best t-shirts.
No, I think that every syndicate that I speak to struggles with this. They might have 6 people, they might have 7 people. They're still not, coping with the management of that. So I think probably what you've done sounds very impressive. So I'm very interested.
Yeah, thank you. I mean, just as an add on to this point before we move on is I think the efficiency part of it is the harder not to crack than to scale, right? If you're, like you said, throwing 6 people at it to build the base, it's 6 people more time, and we know like you got to balance out the economics of this. Yeah, totally agree.
Yeah.
Did you join other syndicates before you started forming your own?
I did. I followed along with other angel groups and other syndicates just to see how things were doing, just to sharpen my own skills as an investor, which I think, maybe to the next part of the discussion, like these are great tools, right? Like my value proposition to my investor network is, you know what? I'm going to do deal sourcing for you. I'm going to do diligence. I'm going to package up data rooms. I'm going to write up deal memos because this is my very nerdy way of fun at 11 p.m. at night, and that's okay by me. There is no commitment, no expectation from investors. You get to see all of this for free effectively, and it's a learning tool, right? And I think if the deal is right, then investors will jump on board. So that I'm confident.
Why do syndicates exist in venture? What role does an angel syndicate play when we already have VC and we already have individual angel investors out there?
Yeah. So there's a few different ways to look at this, right? One is you think about the capital continuum in venture. You've got angels where, for the most part, people write 4 or 5 figure checks. You've got VCs that are writing mid 6 to 7 figure, maybe even 8 figure checks. So it seems to me that there's a little bit of a chasm in the middle in that 6 to 7 figure range where syndicates fit very nicely. Besides that, I think also it's great. It's a fundamentally different product that fits nicely. If you're an angel, you're looking at deals. Okay, how do I find deal flow? How do I do diligence? You're kind of ramping up, figuring that out. I mean, those are learnable skills to be clear, but you've got to figure all of that out when you're starting out. And it's hard, right? If you've got no baseline. Then classically, in venture, you say, okay, there's a VC fund. And, if you want a quote unquote professional investor to do this for you, you can deploy capital with them and they'll just do it for you. Well, what's the problem with that, right? As an angel, you might not have access to deals. You are capital constrained. You might not have the skills, the experience to do diligence properly. And so you're investing from a point of disadvantage. You could do the VC fund, but on the very, very low end, the minimum buy-in for a VC fund might be $250,000. That's a lot of money. So affordability is one issue. If you invest through a VC fund, you're buying some diversification, but you're locked into that particular fund's thesis. You are also abstracted from the learning process, right? Again, why are we here spending lunch, listening to Alan and Emily and Jed talk about startup investing, right? There's a bit more to it than pure financial return. I think we're all motivated to learn. So I think the syndicate as a product makes a lot of sense for angels. You have decision control over your portfolio, same like being an angel. You get to benefit from, I don't know, what we might call economies of scale from Emily and Alan finding companies, doing diligence and say, hey, I think this is what a good product-led company looks like. And to formulate that thesis to investors. And so, yeah, it's a great product, deal by deal, portfolio construction and decision control. I think that's why it makes sense for angels.
Cool. Great. Thank you. What about when somebody's just getting started as an angel investor? Are they better off starting out investing themselves directly individually? Or should they start out in a syndicate and then, if that goes well, consider investing individually directly?
Yeah. I think both options are on the table. I'm going to steer away from making a hard recommendation one way or another, just because obviously I've got my own vested interests, I've got my own syndicates, but it's not an either or, right? You can have both. And as a life principle, I like optionality, right? So why not do that? You can look at direct deals. You can also be part of syndicates and to see what's out there. My general advice for angels starting out is actually to be a little bit more judicious in the decision-making process. The reason I say that is that in venture, like some of you might have heard this term, that they say venture is a game of power law. And effectively what that says is that in any given portfolio, very few companies will return a very large return multiplier, and a lot will be returned very little or outright go to zero. It's like the 80-20, right? In a way. As a law of math and statistics, it's 100% correct. My issue, or where I'm calling, where there's a distinction with power law in venture, is that in venture, when people say power law, they are making the argument for diversification.
Yeah.
Right? They're saying invest in enough companies in order that if you have enough hits on the dartboard, effectively, you'll find hopefully those one or two that return the outside returns that pay out the rest. Again, true. But the risk profile for angel investors is different from VCs, right? So with VCs, power law is a very VC-centric tagline, right? It makes the argument also, in a way, invest in VC fund because we help you diversify and therefore you get power law.
Yeah.
Good. There's nothing necessarily wrong with that, but I think it's also good to be aware of everybody's economic incentives. In a VC fund, there's something called the GP commit, which is what the partners put into the fund. Typically, that's 1 to 2% of the fund. So, which means that in a fund, 1 to 2% of the capital comes from the GPs. 98 to 99% of the capital comes from investors or LPs. So the fund managers get to lever up on capital 50 to 99 times, and they make carried interest on that. As an individual investor, yes, power law applies, diversification is important, but you don't get to lever up on capital. So you can't translate that same principle of power law because the risk profile for angel investors is a lot higher. That's kind of my point, which is to say, the advice I want to give investors starting out is like, when you want to get started, hey, great, but do take your time. It's easy to get excited, and I understand that, right? You want to feel like you're in the game. It feels like inaction. You're on the sidelines from saying no. But when you're starting out, statistically, your lens of investing, you just don't know what good looks like, right? It's not a value statement. It's just inexperience. Well, take your time, see a lot of stuff. Go do direct deals and see lots of pitch decks. Be part of different syndicates. There's no exclusive relationship, in my view, to any of these, and just refine your lens as much as possible and be a conviction investor, specifically because the risk profile for this asset class is so high.
Time is a form of diversification as well, right? Like there are different starting conditions for startups every 3 to 5 years. It's a completely different startup market that new companies are entering into.
Yes. Time is an interesting one, right? I'm thinking more and more about time in different dimensions as an investor as I mature. The venture scale returns, we're talking 3, 5, 7, 10-year returns, because they're so long, it makes the argument for starting earlier. So you have time for these investments to play out, which kind of goes at odds with there's a tension with what I said earlier, right? Which is your risk profile is higher, you're less experienced, so you should take your time. So there is a balance. The other part about timing is actually market cycles. I think this is the point that you're driving at, Alan, with all the craziness that's happening in the world. And since I started building my syndicate since 2020, it has not been a normal time, right? We had the pandemic, then we had elevated interest rates, and I thought things might be stabilizing this year, but now we've got all this terror threats, geopolitics that's just spiking again.
Yeah.
But the other way to look at it, right, from a time perspective, is that if you look at a broad enough time scale, the last 20 years, we saw a run up in venture capital funding up to the end of 2020 before all of this wonkiness. It's no doubt, it is tough times right now. It's causing a very hard reset in venture markets. And I think, in my view, actually one that's healthy and needed. We basically had a 20-year cycle of founders building companies with almost unlimited or free money. So in a way, one way we can look at this difficult time is that if you are long on venture, you could make the argument also that it is the best time to buy in now because valuations are resetting. We do have to be careful about capital scarcity. This will last another at least a year, I think. But if you can account for that, valuations are resetting. I never thought I'd be a stage like right now. We're looking at Series B deals because capital is so dry, right? And so there's different ways to play this. I mean, my main message is that from a timing perspective, if you are long on venture going forward, we might be, something akin to like buying a dip in private markets right now.
I think our perspective in Australia would be that, there's a sine curve in valuations and available capital. And in Australia, it seems like we never really hit the same bottom as the rest of the startup industry in other geographies. And neither do we ever really hit the same high. We should pretty, relatively consistently, not quite enough capital in the market and pretty low valuations compared to other geographies. Where you sit, based in Singapore, but with syndicate members, all over APAC and in the US, do you look at kind of your home markets where your deal flow comes from, or do you look at where your majority of your syndicate members are based?
Yeah, we have a little bit of an interesting structure that's unconventional or unlike a lot of angel networks or syndicates in that we are not geo-restricted. We can talk about this later, but there's this intersection point between what Jed does running an angel network or syndicate and our education business. There is an intersection between those two pieces, which is our investment committee. Very simply, through our programs, when somebody completes it, I invite them to join my investment committee so they get a seat at the inner circle. Why? Because investors just want to get hands-on. They want to learn. People are coming for skills, not knowledge, right? People are just learning for its own sake. People want skills. And through this structure, Alan, we operate 3 investment teams. I have a US team looking at US deals, one in Europe looking at Europe deals, and one in Southeast Asia. That's really our model. And it's been very insightful. And also sometimes a challenge in terms of getting perspective, because now we're seeing deals in different stages. To your point around what is happening in Australia, like I do believe that if you see a tailwind with something with a market, you've got to be in position before that tailwind hits. Is that timing for ANZ right? Now that you're seeing some validation, things like Canva and things like that, could be. I think it's a really interesting place to be, right? I mean, capital scarcity aside, that is a separate problem. And from what I gather in our past conversations, regulatory regime in Australia specifically, that there's also an element of geo arbitrage, right? Especially if it's product-led software companies, the market, there's going to be a far bigger market outside of Australia. Is there a playbook where these companies go out and you benefit from that valuation bump, right? We've seen companies do that. Could be part of the thesis.
It's something which has gotten a lot easier since the pandemic. It used to be the case where if an Australian startup was going to try and raise money in San Francisco, for instance, you would have to pack your bags and head over there for months at a time or back and forth several times in order to raise money there. Now, at least, if you have the right connections and if you seem relatively convincing, you can jump on a Zoom call with somebody who's a venture partner at a US fund. So that arbitration opportunity probably exists, but we see more cases in Australia where local startups, the first round, second round capital was mostly led by and mostly filled by Australian VC. Does that happen in Singapore too? Is it mostly funded in the same market as the startup's origins?
Yeah, I'd say so. The only exception, at scale would be the US, right? They get to defy gravity a little bit, but let's see how it goes going forward, right? The world's certainly it's certainly not business as usual these days.
Yeah, cool. So as an angel investor, I'm free to join as many syndicates as I want. That gives me access to deal flow across multiple syndicates. Is there a point at which I should stop joining new syndicates? What should limit my scale as an angel investor? How many syndicates should I join? And why should I stop?
I think it's more a matter of which syndicates are right for you. I think that comes down to a function of two things. One is, does whatever your investment thesis is as an investor, what sectors, what are you interested in, does that align with the syndicate? That's just table stakes. The other part of the equation, is this syndicate a good custodian or fiduciary of your capital? One of my gripes with angel networks and syndicates is the level of what constitutes, let's say due diligence and what it means to package up a deal. It varies dramatically. Some are just not very good at it. They'll literally have a landing page and they'll share a pitch deck and I've got a deadline in 2 weeks. You need to commit capital. I think the whole point around leading a syndicate, and by the way, taking economics on the deal, is that whoever's running this, you've got to be earning your bread. You're aggregating capital, so you've got leverage to be getting information, and alongside that, be doing proper diligence with the startups. Otherwise, what's the point, right? You're just a broker. There's a difference in terms of alignment of interest. I mean, my advice here is, yes, pick syndicates whose investment thesis fit your interests. But the simple thing to do is ask for the diligence on a recent deal. See what they provide you, right? And it's are they doing any actual value add work beyond just, I found a deal? And then focus your energy on those, 3, 4, 5 syndicates, whatever it is that you're interested in.
Is it worth asking for an introduction to a few other syndicate members so I can interview them about what their experience has been like so far?
You could, but it's a little bit, I don't know if it's all that effective. It's like going to a job interview and they ask for a reference. Of course, you're going to pick something, you're going to say something nice, right?
Yeah, maybe it'll help. It's all part of the due diligence process.
Yeah, it's fair. Doesn't hurt. Yeah.
So why would an individual angel investor consider leading their own syndicate? It's too late for me, but
yeah. So here's the way I look at it. If you are long on venture, you're serious about doing this, you're going to be deploying your own capital into startups. The risk reward on running a syndicate is far better than being an individual angel. Okay. Your ability to write, let's say, a 6-figure, $100,000 check, it immediately opens you up from MVP pre-seed companies up to seed, up to Series A, maybe. So you get better stage access. Writing a larger check, you are going to inherently get more deal flow. So you have more choice. Writing larger check also means you get to do better diligence, which means better decision making. So all of those levers work in your favor. And on all of these deals, the syndicate lead makes economics. So for me, it's a no-brainer, but it does take a certain kind. Like you have to like this enough to be willing to do the work and to be playing this for the long game. I could make the same argument actually for emergent fund managers, people that do want to start a fund. Something like, I want to say 40%, some of the data I've seen suggests that around 40% of first-time funds are sub $10 million. $10 million sounds like a lot of money, for a fund, but it's really not. They're basically writing the same check size as a starting syndicate would. So why take 3 years to raise a fund? Be writing 100 to 200K checks, when a syndicate, if you do the right things, you can be in market for 3 months and launch your first deal and to be writing a comparable check.
And therefore to have all the same leverage over terms, right? So to be able to get, information rights, board observer rights, pro rata and following rounds.
Exactly.
A lot depends on how big a check you can write, whether it's your funds check or you as an individual or you and all of the members of your syndicate.
Yep. Yeah, you're absolutely right. I think like the leverage is the key to this, right? I think in private markets, whenever we say markets, we want to think that it's this efficient creature. Even the public markets are not that efficient. Look at how things are today, and private markets even less so. Yeah, you're right. It just comes down to leverage, and it's a negotiation on these things.
Cool. So tell us about AngelSchool.vc. I jumped in on a call and learned a bunch about it recently, but the Angel School doesn't yet have much visibility in the Australian market. Tell us about how that works and who it's designed for.
Sure. Let me talk about the mission. Why do we exist? I think that there are some fundamentally broken or suboptimal pieces in venture ecosystems. One is that venture ecosystems place asymmetric focus and resource on startups and founders. Not that there's anything wrong with that, by the way, right? I don't have an issue supporting founders and startups. I'm saying we have the balance wrong because we treat the capital side of the equation as an afterthought. We sort of go, wow, okay, we'll help them start with grants and like programs and all of this. But when it comes to raising capital, generally around the world, we sort of go, okay, go find angels, go find VCs, and period. So we treat the capital side of the equation as this fixed sum afterthought, right? It's like, oh, by the way, it's just out there. I categorically reject that axiom. I don't think that in venture there is scarcity of capital in any market. Problem is capital sitting on the sidelines for very basic reasons. It's like, I don't know how to find deal flow. If I find a company, I'm supposed to do this thing called due diligence. What does that actually mean? I get this stuff, this cap table, which is I can discern his ownership percentage, but so what? We just don't know what to do with it. And because that barrier to learning is so high, that capital sits on the sidelines and it just doesn't participate. Another part of venture, which I think is an issue. And when we started this, I talked about the industry being a bit exclusionary, gatekeeping. If we look at capital going to underrepresented, different genders, there is clearly a massive problem. How do we solve that? Beyond doing like LinkedIn posts, right? It's a feel-good thing. We're not actually moving the needle. I think how we solve it, and I'm a pragmatist, we solve that by creating not just more investors on the capital side, but also more diverse market participants. This is how you do it. So what Angel School does, I describe ourselves as an accelerator for investors, the same way they are for founders and startups, but we're solving the capital side of the equation. And we are going to be with investors from 0 to 10. Okay, so 0 to 1 means you are learning venture as an individual, as an angel. How do you have like the core skills? Like how do you internalize risk? How do you do due diligence, technical skills, soft skills, all of that stuff? The 1 to 10 is how, if you're an experienced investor and you want to take it to the next level, have your own angel network or syndicate, I'll teach you how to do that, right? Exactly from my programs, my own playbook, my own tech stack. How do I set it up? Best practices, all of this. The goal is foster more on the capital side of the equation. It's either more angel investors as market participants, as capital allocators, more super angels like you and Emily, giving you best practices on day one, not just scaling, but also efficiency. Because I want more people to help out founders. I can't do it all myself, neither can you, but maybe collectively there's some way to move the needle.
Right. So how long does this angel investor accelerator program take to go through?
We've got a couple of programs. Is it okay? Would it be okay to like put up a couple of slides at this
You
point?
can throw up a couple of slides.
Great. Thank you. I'll try not to like bombard us with this.
Need permission?
Thank you. It's taking a second to load. There we go. Can you see? So I teach two programs, right? The one on the left is called Venture Fundamentals. It's 1 month cohorts, online, self-serve, self-directed, very lightweight. And essentially, we are giving individual investors real venture skills in just 10 hours. I jokingly call this my time machine program in the sense that if I had a time machine and I could rewind time 8 or 9 years and could tell a younger Jed, hey, before you start writing your first or early checks, give me 10 hours of your time. Not a whole lot. That's all I'm asking for, right? What do I want him to? On the right, the Syndicate Blueprint, it's an 8-week program with live weekly sessions for 2.5 hours. I teach this personally, very small handpicked cohorts, usually only 10 people per class. And the goal here is go be able to capitalize deals at 6-figure scale, carried interest on all of your deals. Some things that I'm very proud of is that in our education business, we have impacted, I want to say, 300 investors in 40 different countries. Every single avatar here represents an actual person. We do graduation certificates for everybody when they complete the program. This is why we have this. We have also helped create and launch 20 new syndicates in 14 different countries, as far away as Saudi Arabia and Kazakhstan, of all places. So I'm proud of the work that we do, and I have no marketing budget, right? It's all word of mouth and referrals. Like I firmly believe in the community. And yeah, so there's a very quick plug about the programs and also, how we do operate. There is one thing more, if you don't mind. I just wanted to knock this out.
Yeah, thanks.
Before so I don't bombard you all in slides, which is that I just need to find the right thing. As you all can see, I have a lot of slides. It's my superpower in life, I realize.
I'm so impressed somebody is able to manage such a large slide deck in Google Slides.
At some point, I'm sure Google's going to say, like, you're out of slides, mate, or something.
Your free account is expiring. Oh, no, there goes your software stack cost. So,
yeah, exactly.
$90 a month.
Yeah. I'm going to drop a link in the chat for all of you for this 100% free resource. It's a masterclass series I did for angel investors. And this is like my gift to all of you. So I'll give the link and feel free to sign up for it. And Alan, and please feel free to share it for the people who weren't able to join today.
Thank you. And I should say that I was part of this and enjoyed it very much. I do suggest giving it a try.
Thank you.
Jed, we might see if we have any questions from our callers. If anybody wants to throw up a hand or chuck something into a message chat, we have a few minutes remaining on the call. So if anybody has a question for APAC's most significant angel investor in terms of experience and number of syndicate members. Well, with that, coincidentally, I was in Kazakhstan last year, Jed. Do you think that's possibly why Kazakhstan angel community reached out to you? That they maybe met me in person, had a couple of beers in Astana, and that's how that happened? How did they find out about you?
I don't know, actually. Things are happening for sure. Right. And it's kind of interesting. Like a couple of months ago, I was in Riyadh speaking at a conference. I do so much of our work virtually and online, and it's crazy that a couple of our community members who I, up to that point, had only met over Zoom calls, like sitting there in the audience, right? So we love these moments that we're able to have this impact and visibility around the world. But yeah, it's some combination of LinkedIn, SEO, and things like that. So yeah, it's exciting.
Very cool. I was there actually with Sasha Wheels on our call today, and we were there for a youth entrepreneurship competition, something called the Enactus World Cup. And it was huge. And the startup ecosystem there is much, much bigger than I certainly appreciated till I went.
Brilliant.
Yes, if you can see, that's
Oh, wow.
the foyer of the student entrepreneurship program. There were thousands of people from around the world, I think, and that the Kazakh government is crazy about entrepreneurship right now. They have student entrepreneurship programs, education programs starting from our equivalent of primary school onwards. And Astana itself is one of the most amazing modern cities. Makes Singapore look a little dated, to be honest. So check that out. So looking at the chat, we have some stuff here. We'll start with Chris. Chris' question: how often do you see that the FNF angel funding has been at too high valuations, making it difficult to invest? Chris, do you want to unmute there?
Sure. Thanks, Jed. That was very useful and nice to kind of frame it all in terms of analogy of an accelerator for investors. But something that I've seen a bit of lately is where early stage companies are coming and approaching with very unrealistic valuation expectations for where they're at because they've done a friends and family round at a number that kind of they're then looking for either investors or angel syndicates or whatever to go in, basically. And when I've looked at it, it's been kind of twice as much as or more as what market benchmarks would be.
Yes. I totally agree, right? For me, the data is very clear. Early stage investors, especially angels, are guilty of overpaying. How do you solve this? Part of the problem is like education, to the extent that I can educate and help people understand why you shouldn't overpay, sure, that's a drop in the bucket. Ultimately, it's a systemic problem, right? I think the best thing that you can do as a price taker, as individual angels are, you should just be prepared to walk away. If the price seems high, it probably is, and walk away. But unfortunately, the reality is that on any company, if they're raising capital, if enough investors go for it, this is how price is set. Right? The number one thing, in my view, just practically speaking, that correlates with valuation is supply of cash. I said I was done showing slides, but this is kind of like, I'm going to take the opportunity.
Go for it.
Can you see this?
Yeah.
Okay. So what you're looking at here, this chart is seed stage companies quarter on quarter from 2020 till mid of 2023. So we're looking at almost 4 years of data. On the left, the chart shows median cash raise round on price rounds for seed stage companies. On the right is median pre-money valuations. Visually, you don't have to be a statistician. There's a correlation. Yes? All right. Now, you can make the argument, oh, it's just angels, they're just like less sophisticated, blah, blah, blah. People can lean on those explanations, but it doesn't hold true because it carries over to Series A. It's in Series B. It's been in Series C, Series D, Series E. All right. This is not rocket science. We're just looking at side by side. Cash and valuation. Is there a pattern? So, yeah, I mean, my view is this stuff will happen, which is why I'm especially careful of going into any region, any market, any sector that has a lot of heat, simply, to be part of it, because this pattern will be there. I was in, just mentioned I was in Riyadh, and I did look around, and Riyadh's a funny place, or the Middle East. A lot of this is driven by government money, and it distorts incentives. And there were startups who were literally raising $40 million valuation rounds without any revenue. It's just like, this is nuts. This is crazy. And this adage, oh, it's a hot company. And it's like, no, it doesn't hold water for me, right? And I'm a little old school. I'm just like, no, back to basics. I like business model. I like cash flow. I like margins. I want to invest in growth, and I don't like to invest in hype. That's my view, Chris. I think to sum it all up, you got to be prepared to walk away. In the end, let somebody else. It's the greater fool theory,
Speaking of grown fools, there's also a great question here from Terence about companies being able to remain private for longer, and about how, if you're able to get an investment return as an angel investor now, it's probably going to be in a secondary, or that you might have to take a steep discount on the market price to be able to get your cash back. Is that what you see? Do you see that changing?
Yes, another great question. I really like it. And incidentally, on secondaries, I did a keynote around this topic Q4 last year. So I do have some research. But here's the net of it. For me, the answer to this, unintuitively, it all comes back to like fundamental due diligence. Are you finding companies doing the right diligence and picking the right ones so that they are above average, top quartile performers? The reason I say this is that, look, where exits are scarce, the only path of liquidity is secondaries. You are right. Within secondaries, you've got pure secondary. This is what I'm calling it. I don't think it's an efficient term, but the pure secondary, which is the idea the company is doing well, there is an up round. The new VC that's coming in wants to take more ownership stake. They are willing to buy out existing investors at the new valuation, right? This is the cleanest, best price you will get towards a secondary liquidity. The alternative is secondary markets, where an existing investor, private investor, is trying to liquidate to another investor who wants to potentially buy in. What's the problem there? You have asymmetric information. As the investor, I hold more information than the buyer who is on the outside. So you're immediately pricing it in opposite directions. The data on secondaries also is super clear that it's clearly a buyer's market. Okay, this particular slide is very insightful. We are looking at it's a pricing index of secondary transactions relative to the last price round. So imagine you invested in Series B, it was $50 million valuation. What did the secondary transaction happen at some point in the future? We're going to focus on the black line, right? Which is the median or average deal. The timeline is insightful because we are seeing exactly in the middle here at the end of 2021 where venture. So on the left, you've got the bull market, and then on the right half, when things started tanking. What the data says is that in a bull market or venture peak, the median secondary deal was trading at par value or perhaps a slight discount to the last price round, which in itself is not an amazing deal, right? You've invested, let's say Terrence did a Series B investment at $50 million valuation. To exit that position 12, 18 months later, you're selling off at $50 million valuation on the median deal. Okay, so not a good outcome. When liquidity is starved in the venture pullback, we saw this discount going down to 54%. So now Terrence, having invested at $50 million valuation to exit 12 or 18 months later, he's got to sell for $25 million. It's a crazy steep discount. It doesn't work. And so this is like kind of like my point and why I say it goes back to due diligence. If you pick good companies, you want to be above median, because this is when the company has a path to an IPO, a legitimate trade sale, not an acqui-hire, or or you might actually get a secondary transaction that you could swallow the price of. I hope that's helpful, Terrence.
That's great. Thank you, Jed. I'm aware that we're a little bit over time, so I'm just going to take this opportunity to thank you, Jed, and AngelSchool.vc for joining our syndicate and friends of syndicate here on today's call. I also want to thank everybody who came along and took some time out of their lunch break to learn a little from Jed and the way that he sees angel investing. It's detailed, it's authentic, and it's coming from a place of wanting to help other people to perform better in angel investing. And I think that's to be applauded. Jed, if somebody wants to find out more information, there's that link that you put in the chat earlier. I'm going to make sure that we get that out to everyone who's a member of the M8 Syndicate. And in the meantime, they can always find more about you and about Angel School at AngelSchool.vc. Is that correct?
That is
correct. Thank you very much, everyone, for joining today's call. I'm going to try and pull off one of these about every month. I don't think we'll ever have somebody back on the show who's got 1,400 members in their syndicate, but he's out there, is a friend of Main Ventures, and hopefully we can call upon him again as times change. Jed, thank you very much again, and we appreciate the time.
Thank you, Alan, and also Emily, and nice to see all of you. Thank you for spending lunch with me.